Today, we've got a storm warning that's not about the weather. Billionaire investor Warren Buffett is sounding the alarm about a thunderstorm heading straight for the U.S. real estate market. This isn't just any storm. It's a $1.4 trillion debt-fueled tsunami, and it's already starting to make waves. Warren Buffett's warning about the impending storm in the U.S. commercial real estate market raises critical questions about the factors contributing to this crisis. It's essential to fathom that this warning isn't just the intuition of a financial sage, but a reflection of the challenges currently brewing within the market. Warren Buffett's longtime partner, Charlie Munger, has voiced similar concerns, further solidifying the gravity of the situation. The core of their concern lies in the accumulation of bad loans by American banks and the persistent decline in property values. This convergence of financial issues signals a looming disaster in the commercial real estate sector, one that could have far-reaching consequences across the broader economy. As we delve deeper into the crisis, it's essential to gain a comprehensive understanding of the dynamics at play in the world of commercial real estate. The prolonged era of historically low interest rates has played a pivotal role in shaping the landscape of the U.S. real estate market over the past 15 years. These near-zero interest rates have acted as the formidable fuel propelling the market to unprecedented heights, with far-reaching consequences across the entire spectrum of property investments. These historically low interest rates have created a unique environment where borrowing substantial sums of money to finance property purchases became extraordinarily appealing. The prospect of securing loans at such favorable terms attracted investors, businesses, and individuals alike. This enticing financial landscape triggered a significant surge in the real estate market, ranging from the acquisition of residential homes to commercial buildings. For instance, consider the scenario of purchasing a $1 million office building with a meager $350,000 available as equity. In this case, the remaining $650,000 is secured through a bank loan, facilitated by the alluring low interest rates. The affordability of these loans underpinned the profitability of property investments during this period. It allowed property buyers to leverage their equity to acquire substantial assets, catalyzing the real estate market's rapid expansion. The impact of these historically low interest rates extends beyond mere profitability. It underscores the urgency of comprehending the storm on the horizon, a storm that originates in part from the very conditions that made property investments so attractive. The impending crisis in a commercial real estate market serves as a stark reminder that the interplay of financial factors can shape markets, presenting both opportunities and challenges that necessitate careful consideration. To navigate the complexities of the impending crisis, it's crucial to grasp the concept of debt service coverage ratio, DSCR. This financial metric serves as a vital indicator of a property's ability to meet its debt obligations. A DSCR exceeding 1.2 is widely regarded as a sign of financial security, indicating that the property generates sufficient income to comfortably cover its debt payments. For instance, envision a scenario with a 5% interest rate and an annual property income of $60,000. In this case, the property's financial health is robust, as it readily meets its debt payments. Understanding this key financial indicator is paramount, as it empowers investors and stakeholders to evaluate the strength of their real estate investments, particularly during periods of low interest rates. The DSCR's role in financial security becomes increasingly evident as we dig deeper into the dynamics of the impending storm. The impending financial storm, marked by rising interest rates, is not a mere metaphor. It's a tangible challenge that property owners in the commercial real estate market must confront. Unlike the relatively stable world of residential mortgages, where fixed interest rates remain constant throughout the loan's duration, commercial property loans introduce a heightened level of uncertainty. This unpredictability arises from the fact that these loans reset at regular intervals, exposing property owners to the fluctuating tides of interest rates. Consider a scenario where the interest rate escalates from a manageable 5% to a more burdensome 7%. The immediate impact is striking, with the annual debt payment surging from a relatively comfortable $32,500 to a considerably heavier burden of $45,500. This substantial increase places significant financial pressure on property owners, and it raises a crucial question. Can the property generate sufficient income to cover these elevated debt payments? The intensity of this financial challenge becomes even more apparent when the interest rate makes a further leap to 9%. At this juncture, the annual payment soars to $58,500, placing property owners under immense strain. The direct correlation between these rate fluctuations and the property's financial stability underscores the critical role that interest rates play in shaping the impending storm. This dynamic illustrates how sensitive commercial real estate investments are to fluctuations in interest rates. When interest rates rise, the financial viability of these investments can be seriously compromised. Property owners must grapple with a delicate balance between income generation and debt servicing, as even a minor increase in interest rates can significantly impact their financial standing. Understanding the implications of rising interest rates is central to comprehending the looming crisis and the challenges that property owners must navigate as they confront this storm head-on. The modern workplace underwent a transformation as remote work became a widespread norm. This shift, driven by the pandemic and evolving work patterns, has had a profound impact on the demand for commercial office spaces. Let's examine how the reduction in demand affects the financial landscape of commercial properties. Imagine an office building that previously generated a steady income of $60,000 annually. However, as remote work becomes more prevalent, the income drops to $40,000. With this decrease in income, the property faces a critical financial challenge. It becomes unable to cover the higher debt payments, which were initially established at lower interest rates. This scenario increases the risk of foreclosure, where the bank reclaims the property from the owner. This vividly illustrates the dilemma faced by commercial property owners as they grapple with shifting market dynamics and their financial consequences. In the world of residential mortgages, buyers typically sign personal guarantees, making them personally responsible for the loan, regardless of the property's performance or value. However, commercial real estate operates under a different set of rules, where non-recourse debt is more common. Understanding this key difference sheds light on the potential outcomes in a turbulent real estate market. Non-recourse debt offers property owners a unique advantage. If the property's value declines, or if the owner finds it impossible to meet the debt payment, they can return the keys to the bank. This contrasts sharply with residential mortgages, where the property owners are personally tied to the loan, even if the property's value falls. In a non-recourse loan scenario, the bank becomes the holder of a devalued property when an owner returns the keys. This difference in loan structure is a fundamental aspect that plays a significant role in shaping the impending crisis in the commercial real estate market. The storm isn't merely a distant threat, it's rapidly approaching, and its magnitude is staggering. Consider the vast number of commercial real estate loans that are set to come due in the next 12 to 24 months, amounting to an estimated $1.4 trillion. The implications of this impending financial challenge are profound, and it's crucial to understand the potential repercussions for property owners, banks, and the broader economy. Many of these properties, purchased during the period of favorable conditions, have either lost value or are unable to sustain the higher debt payments necessitated by rising interest rates. Some have already started to default, and this is just the tip of the iceberg. As we navigate the impending crisis, we must recognize the complexity and scale of the challenge that the real estate market faces. The consequences of these defaults are poised to have far-reaching effects on both large and small banks, property owners, and the overall economic landscape. The impending crisis is not a burden that will be shouldered solely by large banks. Surprisingly, it's the small regional and community banks that are holding the majority of these loans. These smaller banks, which constitute around 2/3 of all commercial real estate loans, play a pivotal role in shaping the future of the commercial real estate market. While impending losses from these loans may not lead to the collapse of small banks, they will undoubtedly have a subtle yet profound impact. Small banks are often deeply embedded in their local communities and are essential for lending to small and medium-sized businesses. These businesses are the lifeblood of local economies, driving economic growth, employment, and innovation. As small banks grapple with the aftermath of the looming crisis, their ability to extend credit and support small businesses may diminish. This in turn could stifle economic growth and have lasting repercussions on local communities and the broader economy. Understanding the unique role of small banks in commercial real estate lending highlights the intricate web of consequences that the impending crisis may weave. In conclusion, Warren Buffett's storm warning isn't about rain and thunder. It's about the potential financial storm heading for the U.S. real estate market. It could have far-reaching consequences, impacting not only commercial real estate, but also small banks and small businesses. Stay tuned for updates as we continue to keep you informed. Don't forget to subscribe to our channel for more insights and analysis. Thanks for watching.